The beginning of the month often marks key financial activities, salary credits, bill payments, and planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments. To encourage this habit, SBI Mutual Fund, in collaboration with Times Network, is launching a nationwide investor awareness initiative, Bharat Nivesh, Behtar Kal. The objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. Now, as part of the campaign, we are observing 4th of every month as a monthly reminder to ensure that you start your mutual fund SIP or ensure your existing SIP continues. So go on and set your reminder to invest consistently and stay committed to our goals for the financial well-being of you and your loved ones. And today we'll be talking about a very special investment option. We'll be talking about multi-asset allocation fund, and to discuss more on this and to go deeper, I'm joined by Gaurav Dharmara, National Head Retail Distribution Alliances. Gaurav, hi, and welcome to this very special segment. The theme of the discussion is how multi-asset allocation funds help protect your wealth and manage volatility. So let's start with the basics, Gaurav. The value of money depreciates over time due to inflation. Now, that's what we always talk about on the show and, help our viewers understand this. But how can investors practically preserve their purchasing power in such an environment? Investing across multiple asset classes sounds really ideal, but it also comes with higher transactional, operational, and even tax costs. So how does a multi-asset allocation fund simplify this for investors?
Hi, first of all, thank you for inviting me on the show. I think a very relevant statement that you made, that whatever you used to spend, say 100 rupees to buy something, 5 years, 10 years down the line, you may end up spending 105, 110 rupees because of the growing cost of inflation. So obviously it is very important that you invest in various asset classes that can give you returns to beat your inflation on day-to-day basis, on a period of next, say, 6 months to next 10 years, right? And ensure that you are not eating out of your capital. Customers have various choices. They have been investing into equities, they have been investing into debt, typically like corporate bonds, government securities, or money markets for the shorter time. Few of them have a liking for real estate, few of them have liking for precious metals like gold and silver. So I think overall, but when you go individually, there are chances that with every individual asset class, the cost of transaction may go up. The complications with respect to operations may go up significantly. The taxation, when you actually need the money, you withdraw the money out of one of these asset classes, the taxation as a major cost comes into play. And overall, the biggest of all is the expertise of managing either of this asset class or the mix of these asset classes. So that gave birth to something called multi-asset allocation funds, where you have a right mix of equity, debt, maybe REITs in form of the real estate units, and precious metals like gold and silver. The combination is created to generate very tax efficient returns which can beat inflation over a period of time and provides a good cushion against volatility in the markets.
Something that I really want to understand, and in fact, you can help our viewers understand this. The biggest challenge investor faces is predicting which asset class will perform the best. So, does multi-asset allocation fund eliminate this need for prediction and timing the market? How does that actually work in practice? If you could just help our viewers understand this.
Yeah, so typically it really helps because the expertise of the fund house, the expertise of the fund management team, which is helping to create the portfolios of these multi-asset allocation comes into play. We all know that we always say that leave the job to the specialist. So as an individual who's sitting out of capital markets is not very well aware that which is the right time to enter the markets or exit the markets, whether it comes to equity, debt, or precious metals. So there, as I earlier said, the combination of such asset classes is created, and depending on the market situation, there is a reduction or increase in the respective asset classes. So just to give you a simple example, last 1.5 years, we did not see much of action or rally in the equity space. There, the fund managers took a good and aggressive call on the precious metals. Earlier, the rally was led by gold, then it was led by silver, and over a period of time, after reaching a certain peak, there was a reduction in such asset classes also. So, very actively over the last 1.5 years, the fund played more on precious metals and lesser on equities or debt, and curated very good returns over the last 1.5 years when the Nifty was nearly flat. So there, the expertise of the fund manager and the fund house would definitely help an individual customer to come over these complications and invest in the right mix of asset classes through this multi-asset allocation fund.
All right, interesting. For a retail investor watching this show, what's the key benefit of a multi-asset allocation fund compared to investing separately in equity and debt mutual funds?
I will just give about 3 to 4 pointers on that. I think the first pointer is for a new retail customer who is coming to the capital markets for the first time. Uh, this is a fantastic product to be in, because here you are getting a good mix of the 3 to 4 major asset classes where generally you can invest to generate better returns. Secondly, for the customers who are already part and parcel of the markets for a longer time, these kind of funds bring in a lot of stability in their large portfolios, maybe about 10 to 15% to a maximum extent of about 20% of their total portfolios can be allocated. Uh, Clearly, because of 3, 4 reasons. One, it brings in a lot of operational efficiency that you don't have to look for investing into asset classes on an independent view. It is a collective grouping of these asset classes. Secondly, obviously, because of the operational efficiency, it brings significantly down your transactional costs, because buying an asset class, selling an asset class separately would cost a lot more than buying them collectively at the fund level. Also, these funds are extremely tax efficient, whether you look at the 1 year long term capital gains funds, which are for multi asset, or the multi assets, which are based on the 2 year long term capital gain. Both of them come at 12.5% tax efficiencies. And most importantly, any asset class changes at the portfolio level does not have an impact on tax triggers at the customer level, because they are done at the portfolio level. So low volatility, low operational cost, much lower transactional cost, easy to operate, easy to manage, easy to liquidate as and when required, gives you a collective set of benefits that a retail customer can look forward to enjoy from such multi-asset allocation funds.
All right. Gaurav, just talking about the structure of the fund, does the 65% mandatory equity exposure in multi-asset allocation funds limits flexibility? How does that compare with the funds having 35% equity exposure? Could you just help us understand this?
Yeah, so as I mentioned that you would find two kinds of uh, tax placements in multi-asset allocation funds. There are ones which are 65%, including equity and arbitrage, gives you a long-term capital gain of 12.5% after 1 year. And the other ones comes on the debt hybrid side, which typically have to maintain a minimum equity level of about 35% to ensure a long-term capital gain at a 2 years level, which is equivalent to 12.5%. We firmly believe that keeping the equity check at about 35% gives you a lot more flexibility to operate in other asset classes like precious metals, like REITs or debt, to ensure better returns as and when the time is there. As I also mentioned some time back, that last year it was gold and silver, which were the key components of asset classes to generate returns for these kind of multi-asset allocation strategies. So thus, a fund with a 35% equity level vis-a-vis a fund with 65% equity allocation would give you more opportunities, more flexibility, more room and cushion to operate on other asset classes.
Lastly, I just want to understand, now this can be one of the fund in the portfolio. So how much of a total investor exposure should go in this kind of a fund?
Uh, I personally believe that anywhere between 10% to 20%, this fund should become a part of your core portfolio if you are an established investor. for the newer set of investors, for the people who have retired recently, superannuated recently, and have their retirement corpuses, this fund could be as high as 40 to 50% of their overall allocations.
Right, with that, I think it's time up on this particular segment. Thank you so much, Gaurav, for taking time out and helping our viewers understand every aspect of multi-asset allocation funds today. Thanks.
Thank you very much. Thank you. Have a nice day. Thank you.
All right, it's time for a short break on the Money Show, but then post that, let's continue and answer your stock-specific queries.